Today, we are going to talk about the cost principle of accounting. What is the cost principle? The cost principle, known as the historical cost principle, is where an account is recorded at the time it is received or purchased. Such accounts are the assets, liability, and equity. Let's take an example of a flower business which has purchased a vehicle for flower deliveries, paying $60,000 in cash. The business records its purchase of the vehicle at $60,000. 5 years later, the business records the vehicle's worth being $30,000. Despite the depreciation of the vehicle, it is still recorded at its original cost of $60,000. However, it is recorded not as an asset but as less accumulated depreciation, because this vehicle's worth decreases over time. A real-life example of this is CSL Limited's 2019 annual report in the section of notes to financial statements. It states clearly that they record on historical cost basis, except for financial instruments measured at fair value. Financial instruments are financial contracts between parties. In CSL's annual report, this includes cash, cash equivalents, receivables, payables, bank loans, and more. There are also other accounts that don't use the cost principle. An example is accounts receivables. In CSL's balance sheet, it is in these two places. Let's briefly look at this case. Accounts receivables are recorded at what we call net realizable value, that is, the amount of cash a company is expected to receive. This is because the company doesn't always receive all of their account receivables all at once, since customers don't necessarily pay at the same time. Let's look at the advantages of the cost principle. The advantages of using the cost principle is that it is simple and easy to record at its original value, and it is also very easy to identify and verify the values of the accounts. On the other hand, cost principle lacks accuracy to what the real values of the business's accounts are. Let's look at assets as an example. Assets would appreciate and depreciate over time, and because the value would appreciate and depreciate at different times, it is harder to identify the correct value of the asset. In summary, 1. The cost principle is an account recorded at the time it is received or purchased. 2. The account receivables account does not use the cost principle. 3. The cost principle has its advantages, however, it has its disadvantages in recording the proper value in an account.